Warning: stop buying these 5 things before 2027, because the wealth transfer has already started, and most people will not realize it until it is over. Wealth moves before the public realizes it. In the 1970s, in the early 2000s, in 2008, in 2020, the shift never begins with headlines. The pattern is unmistakable. Gold leads the move and sets the pace for the cycle. Silver accelerates that cycle. Commodities reset, and then paper assets follow. Why? Because liquidity almost always lifts hard assets first, long before it makes its way into corporate earnings. Investing.com. Hard assets first, long before corporate earnings. And the 5 things you need to stop buying before 2027 are not obscure or exotic. They are the 5 most widely held, most aggressively marketed, most mainstream financial products in the Western investment landscape. The 5 things that the same institutions now recommending 20% gold allocations were recommending at 100% just 18 months ago. Before we go 1 second further, if this is your first time on this channel, subscribe right now and hit all notifications. Because this channel has been ahead of every major silver and macro move of 2026, from the COMEX drain to the JP Morgan position flip to the CB activation. And the analysis in the next 8 minutes is going to give you the framework that the mainstream financial press will run 6 months from now as obvious hindsight. Hit subscribe, hit the bell, and drop your number in the comments right now. Which of the 5 do you think is the most dangerous to hold right now? Drop it when I name it. Let's go. Thing number 1 to stop buying before 2027. Overvalued equities at 22 to 23 times forward earnings. The S&P 500 is trading at a forward price-to-earnings ratio around 22 to 23 times earnings, well above the historical average of 15.3 times. The bull case for stocks requires everything to go right: strong GDP, stable inflation, margin expansion, no policy mistakes, AI spending that actually translates to profits. The bull case for metals requires one thing: that central banks keep doing what they've been doing. Stocks could deliver 7, 10, maybe 12% if everything breaks right. Coin Codex: everything to go right. GDP has already been revised down to 0.7% in Q4 2025. Inflation is running at 2.8% PCE, above target for 48 consecutive months. Oil broke $100 on the Hormuz closure. Policy mistakes: the IEEPA tariffs struck down by the Supreme Court have already occurred. And AI spending has already produced the first wave of data center project cancellations as enterprise customers realize that inference costs have not fallen fast enough to justify the capital expenditure that the 2023 and 2024 GPU rush assumed. The bull case for equities requires every variable to cooperate simultaneously. In the current macro environment, not one of those variables is cooperating. Thing number 2 to stop buying before 2027. Long-duration U.S. Treasury bonds. For the first time since 1996, gold now accounts for a larger share of central bank reserves than U.S. Treasuries. That is not a trend line. That is a tectonic shift in how sovereign wealth views risk. Gold ETFs posted a record $26 billion inflow in Q3 2025 alone. Coin Codex: since 1996. The last time gold represented a smaller share of central bank reserves than treasuries, the internet had not gone mainstream, China had not joined the WTO, and the U.S. national debt was $5 trillion. Today, it is $38 trillion, growing at 50 billion per week. The specific central bank behavior shift that FX Empire documented, sovereigns rotating from treasuries into gold at a pace that has reversed a 30-year trend, is the most consequential signal in the entire fixed income market. When the largest holders of U.S. government debt are actively diversifying away from it, the price of that debt, the bond price, has structural headwinds that no Fed rate cut can permanently overcome. The 30-year bull market in bonds ended in 2020. The wealth transfer away from long-duration treasuries has already started. Thing number 3 to stop buying before 2027: leveraged paper exposure to assets you do not physically control. The gold and silver wealth transfer 2026 narrative is about positioning before the crowd, not chasing after it. When the debt conversation finally becomes unavoidable, when currency confidence wavers, when volatility becomes the norm, those already positioned may have the rare opportunity to convert metal gains into generational assets. The real endgame is debt impacting the currency. If confidence in the US dollar erodes meaningfully, gold does not just drift higher, it accelerates. The street accelerates. Jeff Clark's published framework, veteran metals analyst with 3 decades of documented cycle experience, identifies dollar confidence erosion as the specific trigger that converts a regular precious metals bull market into a mania phase. And the mania phase is not the same as the structural bull phase. In the 1970s, silver went from $3 to $25 in the structural bull phase, and then from $25 to $50 in the mania phase in a single year. The structural phase is where the informed investor positions. The mania phase is where the crowd arrives. And the crowd has not arrived yet. We also believe that most investors are woefully underexposed to gold. When we survey different investor groups, we find that most of them have no exposure to gold at all. We've even had some of the major banks suggest new asset allocation models that replace part of the treasury or fixed income allocation and increase the allocation to 20% in physical gold. We haven't seen that in decades. Gold-silver, zero exposure. That is Sprott CEO John Ciampaglia describing the current state of mainstream investor positioning in a market that has delivered 66% gold gains and 165% silver gains in a single year. The crowd is not positioned. The generalist flood has not arrived. And leveraged paper exposure, ETFs, futures, options, is the specific form of exposure that the CME's margin hike cycles, the exchange's rule changes, and the paper-to-physical disconnect have demonstrated is the most vulnerable to institutional manipulation and forced liquidation. Physical possession is the only form of silver exposure that is immune to a CME rule change. Thing number 4 to stop buying before 2027. Real estate financed with adjustable rate debt. Real estate grew 39% since the COVID-19 pandemic. That spike in asset prices is driving up the potential value of inheritances. Earlier projections put the overall transfer amount at $84 trillion in 2020, but market growth and other factors have pushed that number to $124 trillion. CoinCodex, $124 trillion. The greatest generational wealth transfer in history, documented by Glenn Meada's December 2025 research. And the specific asset class at the center of that transfer, residential real estate, is simultaneously the asset class most exposed to the one variable that the wealth transfer framework requires: rising interest rates in a stagflation environment where the Fed cannot cut without inflaming inflation but cannot hold without triggering recession. Adjustable rate mortgages, the specific product that converts stable monthly payments into unpredictable obligations when rate environments shift, are the precise instrument that transforms a real estate holding from a wealth transfer vehicle into a forced liquidation event at exactly the wrong moment. Thing number 5 to stop buying before 2027, dollar-denominated savings accounts yielding below the real inflation rate. Historically, major technological transitions are accompanied by monetary expansion. When money supply grows faster than productivity, inflation follows. Gold versus dollar is not a theory. It is a historical pattern. When confidence in paper assets declines, capital flows toward tangible assets. You hold it, you own it. That is wealth preservation. XS. You hold it, you own it. That is the specific principle, published by ITM Trading's 28-year precious metals advisory practice, that distinguishes physical silver from a savings account, denominated in a currency whose purchasing power has been eroding at 2.8% annually for 4 consecutive years. A savings account yielding 4% in a 2.8% inflation environment produces positive real returns in the official data, but official inflation data uses a basket that excludes food and energy, the two categories that oil at $100 and fertilizer at $680 per metric ton are inflating at 14% and 43% respectively. The real purchasing power erosion that actual households experience, filling their gas tanks, buying groceries, paying energy bills, is running materially above the official headline, and dollar-denominated savings that yield below that real rate are transferring purchasing power from the saver to the system in a process that is silent, continuous, and invisible on a monthly statement. Now the wealth transfer framework, confirmed by 4 independent institutional sources simultaneously. This is not a forecast, it is a statement of fact. 2026 will be remembered as the year of hard assets. History suggests that periods of structural repricing do not reward hesitation. They reward early positioning, discipline, and the willingness to move before consensus fully arrives. The only question that matters now is, are you positioned to capitalize on what may prove to be the greatest generational wealth transfer of our lifetime? Bullion Vault. The greatest generational wealth transfer of our lifetime. That is FX Empire's Phil Carr, co-founder of the Gold and Silver Club, published January 5, 2026, and the specific assets that are receiving the transferred wealth are documented, not speculated, across every institutional data point this channel has tracked in 2026. Silver up 165% in 2025, gold up 66%, strongest since 1979. 47 commodities hitting all-time records simultaneously. Central banks rotating from treasuries to gold for the first time since 1996. India absorbing 25% of global silver supply. SEBI activating $970 billion of institutional silver allocation. PBOC buying gold for 16 consecutive months. The transfer has already started. The 5 things to stop buying are the paper assets that are on the losing side of the transfer. The hard assets are on the winning side. Now the full honest counter-argument. Silver is more sensitive to timing. What could be a profitable trade one month could turn into a loss the next. To maximize silver gains, consider buying during periods of strong industrial growth and low interest rates. Silver can hedge against inflation, but it is less effective during stagflation, meaning when high inflation coincides with sluggish economic growth. Long forecast. Less effective during stagflation. That is Funding Souk's honest characterization of silver's specific weakness, and it is the most important counter-argument in this entire analysis. If the economic environment that 2026 is producing is genuinely stagflationary, persistent above-target inflation combined with GDP contraction, then silver's industrial demand exposure creates a specific vulnerability that gold does not share. Manufacturing recessions reduce solar panel output, EV production, and semiconductor fabrication. Industrial silver demand is not fully inelastic. At sufficiently high prices or sufficiently deep recessions, substitution and demand destruction become real. Buying at record highs is not a decision to make lightly. Gold and silver do not behave like stocks and bonds, and the economic forces driving prices today could shift quickly. That creates a real dilemma for investors deciding if now is the moment to act or if patience makes more sense. J.P. Morgan. That dilemma is real. Record high prices in silver, $121.67 in January, were followed by a 31.4% crash. The 5 things to stop buying list is not a guarantee that the alternatives perform better in every scenario. It is an analytical framework based on the documented institutional behavior of the entities that are actually moving the wealth transfer: central banks, sovereign wealth funds, hedge funds, Indian mutual funds, and the specific assets they are rotating into and out of. The wealth transfer has already started. The 5 things are documented, and the window to position before the generalist crowd arrives, before the headlines confirm what the primary sources have been showing for 18 months, is the specific window that Sprott, FX Empire, Augusta, and ITM Trading are all independently describing as still open, but not indefinitely. This is financial warfare education, not advice, not signals. Verify before you act. Invest with logic, not hype. OG John, AG, out.